China has major issues to deal with today, along with virtually all other countries. Too much debt, the fear of quantitative tightening, and the stagnation of the global economy. One of China's more recent disruptors has been the Petro YUAN. It has been a major change in the global markets. China wants to give the petrodollar a major challenger, and although it's still in its infancy, it will certainly be a thorn in the side of the US in the years to come. You came here for the truth, so let me unveil that for you. Today we're going to look at all things China. I want to touch on the Petro Yuan first. I want to talk about the tariff situation after that. More to discuss. Let's begin by taking a look at this chart. This compares the WTI, Brent, and the Petro Yuan. The Petro Yuan is new, as I said in the introduction. It is in its infancy, but look in this short period of time how much bigger it has become, and the percentage of the market share is going to increase. It's going to take years and years for it to be anywhere close to the WTI, but understand where this is going. It's very clear to me that in the next, let's say, decade or two, this is going to be a very, very serious competitor, perhaps even surpassing it, which is quite worrisome for a country like the US, for the hegemony that it currently has. A lot of people don't think that it could go this way, but we're talking about the very, very beginning stages, okay? So look at where the WTI was in its infancy. Today, you would have to look back on that and understand how it has come through those changes over the years. And so today, Petro Yuan clearly going to be a disruptor. There's no doubt about it. Look at this. China's crude futures in US dollars, it has been picking up steam right now. You can see on the bottom here, the volume has been quite apparent right here. And this is not going to be something that we should take lightly, okay? We should be looking at the Petro Yuan and understand how much of an impact it really could have. Moving on to this, Petro Yuan oil futures, basically, where we're just seeing the growth from its really beginning up until today, that the trend clearly upward and onward, okay? All right, now I want to touch on some other points talking about the tariffs here. There's a lot in this article out of CNBC. I'm not going to cover it all for you, but I'm going to touch on some major points. I thought it was interesting to see the connection in between China and the US, with Apple being that middle point. It's interesting because the manufacturing base for Foxconn, for their different equipment, iPhones and such, coming out of China, and yet the US is really the biggest benefactor of all of this. Okay, so Apple has benefited from cheap labor and a strong supply chain in China, and needs to share more of its profit with the Chinese people, or face anger and national sentiment amid ongoing trade war. An article in the state-backed People's Daily warns. So that's practically like the mouthpiece of the government coming out and saying, hey, you need to be a little nicer, okay? So they're not necessarily coming out and saying they're going to act upon anything, but it's just interesting to see a paper like this really highlighting what's happening. The opinion piece highlights how Apple made $9.6 billion in revenue in China in the June quarter, helping it go over $1 trillion. But the continuing trade issues between the US and China could leave Apple and other US firms vulnerable to bargaining chips. The eye-catching success achieved in the Chinese market may provoke the nationalist sentiment and the protectionist measures, so on. Okay, so they're talking here about what's going to happen with all these trade issues. It is quite worrisome for these corporations because they're stuck in the middle and they're thinking to themselves, everything right now is working for us. We're making a lot of money. Our profits are escalating, and these trade issues could get in the way. If suddenly components start costing more, they can then sell them to the customer at a higher price, but that might mean reduced sales. Reduced sales, less corporate profits, stock prices go down, not good, okay? So they need to do everything that they can. So they can make some deals, perhaps. Maybe they'll get a free pass, or maybe they won't. So we'll see. It's definitely going to be a big impact with a company like this being so important, all right? Washington is playing double-faced tactics on the ongoing trade issues. It, on one hand, threatened to slap a 25% tariff on $200 billion of imported Chinese goods after initially setting them at 10%, and on the other hand, sent a signal through various ways that it's willing to negotiate from $50 billion to $200 billion and the proposed $500 billion. That's big. From 10% to 25%, Washington's tariff game has been seen through by China. Now, I think that this is something that we've been going back and forth. It's not resolving any problems. This is not going to be the solution. Tariffs have been there many, many years, and actually today there's a lot less tariffs than there ever have been historically. However, just putting tariffs on for these purposes, what they're doing, I don't think this is a good idea. I think they need to sit down, they need to do deals, and they need to make it work for both sides. I've said that before. There's more in the article here if you're interested in reading it for yourself. But I want to move on. All right. One of the problems that is going on today in China is no different than the US, Canada, UK, Australia, and so on. There's consumer debt problems, massive consumer debt problems. Today we could see that individuals where, not that long ago, there was a much larger percentage of people that were not falling victim to the consumer debt vicious circle, credit cards and loans and everything. But today, that's not the case. People are buying things with their margin. People are using leverage as much as possible, racking up the credit card debt and so on. These are the modern quote-unquote conveniences, and they allow bigger risk, and that's what people are doing. All right, so they want to buy stocks, they want to buy real estate. The maximum leverage allows for the maximum profit, of course, maximum risk at the same time. China's consumer debt has grown rapidly. Varieties of consumer debt as a proportion of the GDP, and look where it has gone since 2013 alone. It has made major strides, and that is not a good thing. Whether we're looking at credit cards or mortgages, I mean, see that we often hear, well, people in China don't get mortgages. Yes, they do. Absolutely, they do. This is something that is not just it just happened last year. It's been a growing trend. It's significant right there. I'm highlighting right here the mortgage loans. You can see the credit card debt as well. And non-mortgage consumer loans is right here, but it doesn't matter. I'm just noticing the fact that we're seeing massive amounts of credit card use. Just look at it where it was back in 2013 compared to today, 2017 anyway. Major factor here contributing to the GDP. A lot of people are spending a lot of money that they don't have. Squeezing the bubble. Peer-to-peer lending has skyrocketed, although a government cleanup is forcing out hundreds of online platforms. So not good for business, especially when a lot of these people have their money in with them and they're losing out as a result. The number of lenders, you can see that is declining here. The government's cracking down, but at the top, you'll see the outstanding loans that has increased as well. I think that what's going to happen in China is so many-fold here. This is not a good thing for this country, that they are engaging in the same bad practices as a lot of the other countries out there, taking on too much debt on a national level. They're involved in their own stimulus measures. They are doing the biggest public works projects in the history of the world. We've got stimulus packages going all the time, and yet the GDP year-over-year growth is declining. That is a fact. Even the government of China admits it. They're saying that they have a handle on it. I don't think so. I don't really agree with that, but hey, that's what where we're at today. So I'm going to end it there. If you found the video informative, all you got to do to support me, just give me a thumbs up. Hey, you can give me a thumbs down if you'd like to as well. It's all good, trust me. And that's about it. If you want the financial education that was not taught to you in school, these two books have it all. I actually talk a lot about the US and China relationship in these books, particularly the first book. I get into the asset classes, how to invest in them, talking about the foundation and history, everything. It's basically that education subject that was the financial education that was not really, there was no course on that in your whole entire education that you had. So I took the liberty of writing it, putting it into these two books. Check them out. Link is in the description below. But if you're more interested in the audiobook format, well, you can get that at themoneygps.com.